What is going on, everyone, and welcome back to Financial Footprints Podcast. My name is Kolin Hayes. I am your host, and in today's episode, I want to talk about financial planning for those in their 20s. Because when you're 50 years old, what you worry about with finances is going to be different than when you're 20 years old. And I know that in the financial industry, the average financial advisor is like 50-something years old. I'm not 50-something years old. I'm in my late 20s, so I really want to help people that are younger with their finances. So in this episode, I want to talk about if you're in your 20s, what should you be focusing on with your money? More than likely, you have your first job or you're in your first career after college. Maybe you're still in college. Maybe you just graduated or you're about to graduate this spring and you have some student loan debt. Maybe you're in your late 20s and you're thinking about getting married. Maybe you're just having your first child in your late 20s. But what you're focusing on in your 20s is different than what someone's focusing on in their 50s, 60s when it comes to financial planning. So, if you're in your 20s, what are some things to think about? Of course, you want to think about retirement. Of course, you want to think about estate planning. But that's less likely something you're worried about, at least on the hierarchy of what you should be worried about, than someone who's in their 50s. When you're in your 20s, one thing to think about is, do I have debt? And what is my strategy or my plan to paying down my debt? If you graduated with student loans, maybe you graduated college, you bought yourself a car, now you have a big job, you have car debt, maybe you have some credit card debt. Working with someone or putting together a strategy to help you pay down your debt. Am I going to use a debt snowball method? Am I going to use the debt avalanche method? Which one is better for me, both mathematically, but also for you personally? It might be different than someone else. How am I going to strategize my new income to help me paying down my debt? So another thing to think about with debt is just cash flow management. Like I said, maybe it's your first big job out of college. You're making $50,000, $60,000, $70,000, maybe more, maybe less, doesn't matter, but you're making an income. How much do I set aside for rent or mortgage? How much do I set aside for spending money? How much do I set aside for saving and investing? Maybe cash flow management is something that you're focused on in your 20s. Understanding how much of my income should go to bills, how much of my income should go towards spending money, and how much of my income should go towards savings. You're going to read stuff. Rules of thumbs are great, but they're not great because they don't know anything about you. So rule of thumb is going to say you should save and invest at least 20% of your income. But more than likely, when you're in your 20s, you're making, hopefully, not the most amount of money you're ever going to make in your career. If it's your first job out of college, more than likely, you're not going to be making the most amount of money you're ever going to make in your working career. You might actually be making some of the least amount of money. So of course, you should try to save as much as possible, depending on your goals. But just saying, hey, save 20% of your income might not be feasible. But if you have cash flow management, maybe you have some debt management, how are we going to pay this down and prioritize paying down my debt? How much of my income should I be saving? Maybe it's only 5%. Maybe it's only 3%. Maybe it is 10% or 15%. That's great. Something is better than nothing. But really in your 20s, these rules of thumbs about, hey, you should be doing this, you should invest this much, you should save this much, you should be doing this, maybe doesn't pertain as much to you because your income is not the greatest it's ever going to be. And that brings me to another thing you should be focusing on is not just investing your money. Maybe it's 5% into your 401k and that's all you can do. That's great. That is better than nothing. If you're 24 years old, 23 years old, you get your first job out of college and you're saving and investing 5% of your 401k and maybe you get a match, 5% match, maybe 3% match, and you're at least getting the match in your 401k, you're doing great. But maybe in your 20s, it's not all about investing just your money. Maybe it's also investing in yourself. Maybe there's a certification that you can get in your career, in your line of work, that makes you more desirable, which means you might make more money because you have this certification. Or maybe you have these certifications or trainings or whatever it is, investing in yourself. I've always believed that when you leave college or you get out of the education system, high school or college, that you shouldn't just stop learning. You should always be learning. You should always be investing in not only your investment accounts, money-wise, but also in your education, because that will, again, make you more desirable as you grow in your career for better positions or better paying jobs, because you have not only the work ethic, because you're going to work hard to get to where you want to be, but also maybe the education and the licensing and certifications to back that up. So not only are we focused on paying down debts, maybe cash flow management as a whole, maybe investing something financially, but also investing in yourself. That's very, very important. Another great thing to focus on in your 20s is getting that emergency fund started. A lot of people, they go through life not having an emergency fund. So when something emergency happens, they do nothing because they don't have money set aside to pay for those emergencies. So really focusing on setting a portion of your paycheck aside for an emergency fund and getting that started building up in your 20s as well. Maybe if you're in your 20s and you have a spouse or children, are you properly insured? Not only medical insurance, maybe at your employer, but also life insurance. And life insurance is a whole different episode because I have my opinions on different insurances. But one of the cheapest insurance you can get, this is not a recommendation, I don't know your situation, but the cheapest and a very quick and easy insurance to get is term insurance, term life insurance. You pay for a specific term in time, 20 years, for example. You get a specific payout for a specific monthly premium. Monthly premium is just the amount you pay every single month to get this insurance. So if you have people depending on you, like a spouse or children, having term insurance to cover if something were to happen to you, they would get some benefit, financial benefit, to help continue their means of life moving forward without you, is very important and something to think about. And when you're in your 20s, term insurance is pretty cheap. For $500,000, $300,000, $800,000, $1 million of term insurance, I'm not going to quote numbers because every person is going to get different quotes, but it's relatively cheap to get that type of insurance for 20 years, for example, to pay out to your spouse or children if something were to happen to you within those 20 years. So if you have beneficiaries, insurance is something very important to think about. And real quickly, if you're going to a financial advisor, looking to partner with one, and you're in your 20s, and the first thing they try to tell you to do is buy whole life insurance, please run away. That's my tip for this episode. So I talked a little bit about cash flow management. I talked about debt management. I talked about insurance planning. I talked about saving something, but also investing in yourself. The last thing I want to cover when it comes to your 20s is investment planning. What happens is a lot of people in their 20s, especially with social media nowadays, TikTok, Instagram Reels, YouTube, they see all these flashy investment styles. Oh, you just put all your money in this one stock and it's going to be the one that's going to make you rich. It could be. I don't know. It's worked out for some people. But for the vast majority of people, that's not how it works out. Investment planning in your 20s is just start with a really, really solid foundation. I believe in broad index funds. Those index funds, usually purchased via an ETF, they are great foundations for your portfolio. When you're in your 20s, it's all about just getting money into the compound interest machine. Whether that's through your 401k, whether that's through a Roth or a traditional IRA, whether that's through a taxable brokerage account or any other investment vehicle, that is a great way to just get your money in the compound interest machine. You might not be able to set aside 20% of your income like every rule of thumb says, and that's fine. Hopefully over time in your 30s and 40s, as you make more money, you invest more money. But when you're just starting out in your 20s, I personally like broad market ETFs and buying consistently every single paycheck. A great way to do this is through your 401k. Focus on finding a solid debt paydown strategy, managing your cash flow, being properly insured, and investing in yourself so that over time you can progress in your career, make more money, and reach all of your financial goals. My name is Colin. This is the Financial Footprints Podcast, and I'll see you in the next episode. Goodbye.